Hello, everybody, and welcome to another session of the OIC's Options Education webinar series. My name is Mark Bensquin, and I'm the manager of OIC's Investor Services team. And I'm very happy to welcome the newest member of the OIC family, Dan Kerrigan, president of the NASDAQ Futures Exchange. Dan's going to teach us how traders and investors use options as an insurance policy for their portfolios. And with that, I'm happy to turn it over to Dan as he explains to us how options can be used as insurance. Dan?
Thanks, Mark, and greeting to all investors. Welcome to today's OIC webinar, Using Protected Puts Like Insurance. I'm with NASDAQ, and I'm based here in the heart of Philadelphia. We are centered to the NASDAQ story of running many options exchanges, so today's presentation is near and dear to our heart, and we salute the effort that you've taken to educate yourself on the opportunities and risk concerning options. So before we get started with the presentation, just a few minutes to take a look at the disclaimer. And importantly, options involve risk and are not suitable for everyone. So we encourage you to obtain the characteristics and risk of standardized options, which you can grab by going to optionseducation.org, or the address of the Options Industry Council is featured on this slide. And for today's presentation, all examples are just for hypothetical purposes to illustrate the concept at hand. Commissions, fees, margin, interest, and taxes have not been included. And of course, with any type of investment opportunity, and especially with options and tools, we encourage you to consult with your tax advisor before leaping in. So with that in mind, I'm going to go ahead and get started and just take a few minutes to give you a little bit of a background information about the Options Industry Council, or OIC. It offers a great deal of educational media in terms of rich media of webinars, pods, the different types of educational opportunities, from options from if you're a very beginner to intermediate to advanced. The key takeaway today is if at any time you'd like to follow up or really expand your horizon with options education, simply visit optionseducation.org. And we're not going to leave you hanging without having a live human to respond to different types of questions that you may have that simply aren't addressed here today. So also ask if you'll write down the email address for the Investor Services Desk, which is options@theocc.com. And I can definitely testify the OIC team is super fast with turnaround to questions. Now, of course, they can't help with specific trades that you may have on, but they certainly can help you with some educational materials if you're looking to either enter a trade for the first time, what kind of strategies may be involved, or to repair different strategies, some of the resources that are normally found on optionseducation.org. So let's go ahead and move forward and take a look at the options industry at large. So essentially, I don't know how many hockey fans are out there, but this is really a hockey stick picture of growth. And if you take a look at this, why has this growth been phenomenal after kind of a tepid start from the 1970s into the early 90s? Why the big push up through the turn of the century now into 2018? It really comes down to 2 points. The first point is risk management, and the second point is trading opportunity. And taken together, these 2 points are likely why you have decided to attend today's webinar. So we hope to satisfy your curiosity for education and establish some great tools to help you with your investment portfolio. Now, the Options Industry Council is supported by the 5 options exchange players featured in front of you. And we work together in collaboration to provide educational outreach to investors both on the retail and institutional side. So with that in mind, let's go ahead and go a little bit further with today's presentation of what we're going to cover. With regard to today's presentation, we're first going to look at rights of put buyers, using long puts as insurance, how to determine strike and expiry selection, some trading examples, and managing position. And as Mark mentioned, you have the option at all times to utilize the Q&A box on your web interface to send in any type of question. Mark's going to go ahead and address those throughout the webinar. And of course, we'll look at some at the end of today. But at all points in time, we want to ensure that you have the confidence that you will have basically resources to address questions of any sort. And again, just for that quick takeaway, the email address is options@theocc.com. And the website, once you're finished, optionseducation.org. So let's go ahead and move a little bit further in terms of rights of put buyers. So with all options, when you're a buyer, you're a holder of that position in your trading account, you have the right, but not the obligation, to exercise this contract. And indeed, this is a legal contract between buyer and seller. Now, what right do you have? Well, as a put buyer, you have the right to sell shares at the strike price determined by your option. So as you're beginning to see, the foundational blocks of being a put buyer is that you have all the decision making in your hand. You have the right, not the obligation, and your wherewithal to start to determine how to manage risk or to determine trading opportunity. Two of the drivers that coming into options are coming into focus. Now, for this right, you're actually going to pay a premium to a seller, and that will be cash out of pocket, easy to calculate. Whatever your premium is, it's times $100, and then of course times the number of contracts that you may purchase. Now, when you purchase a put, it gives you the right to dispose of stock at a certain point in time in the future. And the proceeds that you would receive from that put transaction is simply the strike price times the $100, and you would deliver the 100 shares of stock. So at any point in time, when you think of a put and you're buying a put, there's one easy takeaway word in terms of what you're seeking to do when it comes to setting your strategy and managing risk. And that word is sell. Puts are the ideal tool to help you determine potential insurance for a sale transaction at some point in the future. But why a protective put, and why do we call it a protective put? So on this slide, we've got a couple bullet points to help you examine it of how it would relate to you when it comes to portfolio management. So, simply stated, why use a protective put? Well, in the first instance, you as an investor may be bullish on a single name stock that you already own, but you're looking for protection against a downside move. Would be some type of a corporate merger in play, or a target out there. Might be a medical company that has a drug in the pipeline with the FDA. Something that has an effect on the future, which could be very good or very bad. This provides, in terms of today's strategy, a protective put to ensure, that is, protect against a downside move. And puts are ideally situated in that you as the investor, at the point in time that you establish which expiration and which strike price you're going to use, will allow you to set basically a floor price that you can actually sell that stock if needed. So I think it's clear to see that protective puts basically act like an insurance policy. An insurance policy on a stock. And in today's example, the real attribution of a protective put is to basically create that confidence that you have an insurance policy on a single name stock that is a large percentage of your portfolio. I think as you continually hear the name and the concept of insurance, it's really not so different than having car insurance, having home insurance. You want to protect some of the unknowns as you go forward each day into the trading future. So let's go ahead and get into the heart of the presentation. Let's take a look at how we would go about using long puts, like insurance. So the likeness to insurance is really just a measure of the difference between the share price and strike price, which can be considered the equivalent of deductible. So why don't we put that in human talk? Let's imagine that you own stock at $100 per share, and you decide you're going to buy a put at $80 per share. Well, that put, that strike price, is $20 below where you are now at $100. So that $20 gap represents basically your deductible. So if you own 100 shares of stock and your deductible is $20, $20 times 100 shares is $2,000. So your deductible before you're able to sell that stock in case it goes down is $2,000 bucks. Probably you can relate to it. Maybe some of you have a auto deductible of $2,000, whereby you don't begin paying out of your pocket essentially until there's $2,000 worth of damage to your car. Similar concept. That's one of the key attributes of likeness to insurance. And the protected put gives you that wherewithal that in the event if shares plummet, you can always sell that stock at the strike price where you purchased. But of course, time is a consideration. So if along that forward trajectory in terms of time and the stock, if the shares actually don't decrease in value, but they actually remain flat, they trade sideways, or they actually start to rise into an uptrend, if at the time of option expiration, the stock price is greater than the strike price, that option is going to expire worthless. And that out-of-pocket investment that you had has gone now to zero. But you've got to look at the mindset that you put yourself in as a retail or institutional investor. How are you going to think about this investment if you don't use insurance? Can you sleep at night? Is this going to create anxiety that maybe you have an investment that's going to have a big effect on terms of a forward liability, children's education, college, university, all these things? So at the end of the day, how you go about choosing your insurance is basically a measure between what you perceive as risk and really your appetite for risk. And importantly, how you want to protect your portfolio. So with regard to using long puts as insurance, the real question is, are you covered? Can you answer that in your own views? So we mentioned just a little bit ago of how when you purchase a put, it gives you the right but not the obligation to sell the stock at the strike price. Well, that strike price is akin to your exit price. That's where you're getting out, exactly there. That's part of the contract between buyer and seller. And that right will be with you every single day up until expiration. Single stock options are American-style exercise. And what that means is that you control the right to decide if you want to sell that stock every single day on any given day up until expiration. It's what I call the perennial right, always there, always available up until expiration. And also to keep in mind, your profit in your long stock position is already well known to you. Hey, where did I get into the stock? Where's my stock basis? Where's my ownership basis for tax reasons? I understand where it happens when the stock goes down. Do I understand where I profit as it goes up? Yes, it's the same. There's nothing different here in terms of that interpretation. And importantly to note is that with puts, it may allow you as an investor to lock in profits, or it may allow you to limit your risk in terms of if there is a move much below your cost basis. So as you're beginning to see, there's quite a bit of optionality with regard to a protective put for single name stocks. But as you get into the strategy, now you've got to address some questions, or what I like to call the pillars of options trading. And the key pillar, which you have to begin with, is which strike to buy. So just to focus your attention a little bit on the table, we're going to make the assumption that you have purchased shares at the price of $56.50. And as you can see from the table, on the left side, there is a vertical list of put strikes, 55 cascading down to 47.50. And these put strikes represent the actual strike price at which you would sell your single stock if you decided to exercise the put and sell shares. Now, in the middle column and the right-hand column represents a respective bid and ask. Now, one of the great things about being an investor in this country is that there is a highly competitive national market system for options amongst all the exchange operators that continuously post an automatic two-way sided bid-ask quote for all options on stocks. So in the case of what you see here, in terms of the $55 put strike, the bid is $2.16 and the ask is $2.19. And for purpose of illustration, we call this the National Best Bid, Best Offer. And it says exactly what it sounds like. You're getting a look at what is the best bid in the marketplace and what is the best offer in the marketplace. So at this point, I'll ask just to focus your eyes on the right column of ask, $2.19. That would be the price that you would pay if you were to send in a market order to buy the $55 put strike. Correspondingly at $52.50, the ask has now dropped to $1.39. So why is that? Well, it's important to note, just like your auto insurance, what you get, what you pay for. So in the case of a stronger put, which is measured by a higher strike price at 55, it's more expensive in terms of the ask than a slightly lower put, just one down at $52.50. That $2.50 differential has lowered the ask in the put to $1.39. And of course you can see it to 50, 47, all the way down to 55 cents. We're going to get into a little bit further of this type of attribution and how you might go about, as an investor, taking a look at it to determine what's best for you. But one thing's for clear, the less insurance that you need, the less out-of-pocket cost will be for you. And like all options, it's easy to determine the money that you need to pull out of your pocket at any point in time. You simply multiply the ask price by $100 per each option contract. So if you buy the 55 put and you pay $2.19, just multiply it by $100, $219 out of your pocket. So with that in mind, let's go on to another pillar of options trading. And that pillar has to do with time. Everybody says time is money. And is that ever especially true in options? And when it comes to buying that put, right now you recognize that you have to tackle which strike. But you can also have to tackle this time pillar. Do I want really short-term coverage of 15 days? Do I want longer coverage, 30 days, 60 days, or 90 days? Well, this all comes back to your personal outlook for the stock. Is there something going on in terms of a corporate event? Is there a big earnings announcement, quarterly earnings coming up? Is there a drug in the pipeline that the results are going to be known at a specific time? Or is this company might be in the defense sector? Do they have a government contract that's being talked about in the news that your stock could benefit from? Or, resulting, if it doesn't, will your stock find that it has a downward draft? Well, over time, options are affected by price. You can see in the table, again, on the assumption with a $56.50 stock price, that we're going to take a look at the $50 put. So that's the strike price we've determined. Looking at time, which goes by expiry, let's start with 15 days. To make this easy, just focus your attention on the far right-hand column, and you can see the ask price is 21 cents. So if you want insurance on this stock with a $50 put for 15 days, it's going to cost you 21 cents, or times $100, $21 out of your pocket. But look what happens when you move out to 30 days. That option more than doubles to 46 cents. Out to 60 days, almost a double to 87 cents, and then out to 90 days, not so much, but a definite increase to $1.41. So it's obvious to see that as time goes on, with the same strike price, longer time equals greater premium. Now, let's move on to the next section, which has to do with strike and expiry selection. Never an easy topic, but one that requires education, definitely diligence in terms of your risk-reward profile and your outlook for the stock, as mentioned. So, when we look at the strike versus expiry, it comes down to really one question, which is in the first bullet point, and that is, how much coverage do you want and for how long do you want it? So we'd like to look at today our favorite airline, which we affectionately call JetX, and they are in line for an upcoming government contract, likely in the next month. So you as an investor are very bullish on JetX, but you're cautious. So you have some figures that you've come into play from your own research. You've been able to look at some different analyst reports, and you've been able to kind of take away from the view on the street that if the contract is approved, that is the government contract, it's expected that the JetX shares will rise by 10%. But if not, the analysts are saying, look out below, that JetX could suffer a precipitous decline of almost 20%. And you've got a pretty big focal point because you are long this particular JetX stock at $80. So why don't we take a look at what are some of the opportunities in this put option strategy for a situation where you as an investor are long the stock from $80 and you're looking for downside protection. And now you've determined your time frame. You've determined that pillar of insurance is going to be from 30 to 60 days. So let's take a look at the table. And in the first column under expiry, you can see at March. And then in the second column, seeing the put strikes. You can see clearly that the put strikes basically follow a pattern, 80, 75, and 70, and repeat just below. The difference being is that the next expiry is April. So again, in terms of focus today, to kind of get kind of an eyeball on an easy pointer, is just to focus on the right-hand column on the ask side. So if you look at an $80 strike, the ask right now is $3.80 for the March expiry. But how about when you move down to that $75 strike? Now you're looking at a $1.84 price. All right. Keep going down, $70 strike, looking at 85 cents. Now you're thinking, okay, maybe I don't want March. Maybe I want to go out a little bit on the time spectrum. So now you head out to April. Well, you can see that the April 80 put now is $4.85. So if you compare and contrast that to the March 80 put of $3.80, you can see that additional month is going to cost out of your pocket another $1.05 per option, or another $105. Another key point to determine how much insurance, how much you're willing to pay, how much risk you're willing to take in terms of insuring your single stock. And of course, you can see the relegation of the ask down to $1.49 in April. So with that in mind, we've established that over time, that option prices are generally higher, and as you go down in the strike price tree, of course, the option premium is going to go down, but there again, that's going to call into place your strategy in terms of how much insurance, how much risk you're willing to take. So let's look at a specific example here of strike versus expiry. So based on this time frame of 60 days, and now that the investor really feels that they have a good handle in terms of protection, the investor reaches out and says, I have found what makes sense to me in my portfolio, what makes sense to me in terms of what I think I can sleep at night and fits my risk profile. That the investor purchases one of the April 75 puts for $2.70 or out of pocket $270. Always keep in mind the $100 multiplier. So if that government contract for JetX is approved, the stock's going to rally. Remember, the analyst said it's going to go up about 10%. Well, the downside, even though it's an upside stock move, is that the put's going to expire worthless. And you will lose out of your pocket the full $270 or 100% of the funds that you put down for this strategy. But you will have gained on the shares. So did you get your money's worth? That's the question at hand. This is definitely what we call the glass is half full. But let's look at the glass half empty. If that government contract doesn't come in for JetX, it's not approved, and shares now sink from $80 to $65, you can exercise that stock at $75 and sell that stock, put it back to the market, and reassess what your long-term interests are in JetX. Well, let's go ahead and take a look at a trading example and try and tie together this concept. So in the market at this point, JetX is trading at $81. And remember, your profile as an investor is that you're bullish. You're cautious about the outlook on JetX, and you are long. You own this stock from $80. Now, you want to limit your downside risk, but at a price that is reasonable to you. So you're buying that 2-month, that 60-day, $75 strike put at $2.70 or $270. Now, the premium out of your pocket to buy this represents roughly a 3.4% investment of the stock price. So let's go on in terms of how things work out. So let's look at the table again, and there is only 2 points of focus. First is the left is the stock price at expiration, and to the far right, total profit and loss. How are you going to do whether the stock goes your way or goes against you? So let's just take a look first, focus on the $90 stock price at expiration, and then shift to the far right column with the total profit of $7.30. So stock at expiration is at $90. You bought it at $80. So at $90, you got a $10 profit. So you're happy. But to determine your total profit, you need to subtract your out-of-pocket premium of $2.70. So that's how you come up with the $7.30 net profit. $10 open market profit subtracting the $2.70 premium. So I think we'd all like the $7.30 profit. But now let's take a look at the downside in terms of, did this protective put accomplish what we set out for it to do? Now, if you go down to 80 at expiration, what happens to the put? This is now what we call a situation where that $75 put is out of the money. So it's going to expire. There's no reason to exercise that put because it's $5 below where the market is right now. You wouldn't exercise and sell your stock at $75 when you can get $80 in the market. So now your out-of-pocket loss is $2.70. All right. So how about next level down? Stock goes to $75. Now we show a loss in the far right corner of $7.70. How did you arrive at that loss? Well, you own the stock at $80, and you've decided you're going to exercise that put and sell your shares at $75. You've lost $5 out of hand on your long stock position, and you paid out of pocket $2.70 for the put. Add them up together, $7.70 loss. Now, you're willing to take that loss because you zeroed in on the 60-day put and the strike price. And look what happens as the market goes lower. your total loss remains at $7.70, no greater. So the protected put in this example 1 has accomplished its goal in an exact means. It has captured your wherewithal to protect your portfolio. And in terms of the chart that we have here, just going through, we've identified the maximum loss, and that's where I always like to focus as an investor. I'm quite risk adverse. I want to know, what's my worst downside situation? Well, there's also a break even on the upside. Hey, where am I going to really take off? And this is one of the great opportunities with using a protected put as a strategy. The stock price can go to the moon, and your break-even price is going to be where you got in that stock plus the out-of-pocket premium, and in this case, $82.70. So very simple to determine your break-even at expiration. If you want to look at where you're going to be in terms of the upside. So with that in mind, let's go on to the second example. Now, how about a pharmaceutical company that is looking for drug tests to be quite positive coming up? So we all know the story there. Shares can really move like a rocket. There can be an exponential move. But at the same time, if that drug pipeline, if that approval fails, then there's going to be a pretty big downside move. So looking at this hypothetical company that we're looking at a situation where we're going to purchase 500 shares at $42. And that out-of-pocket cost is $21,000, just 500 shares times $42. We're going to also examine the price of a 60-day put with a strike price at $40 for $1.50. But we're going to need 5 contracts because we have 500 shares. And remember, each contract for a put option underlies 100 shares. So now we're going to have to pull out of our pocket $750. So the total investment for this strategy now will be $21,750. And notice that that protection that we're coming up with in terms of the strike price is 3.5% of our investment. So now let's just take a look at our, where we are in terms of where the stock is trading. Trading at $42. So again, you're bullish, but you are a cautious bull. You're not a raging bull. And along those 500 shares for $42, and you decided, got to limit that downside risk. You decide, look, I'll buy that 2-month $40 strike price put at $1.50 each. So we've got the trade on, a protected put. These 2 trades show up in your online brokerage account when you log in. So let's look at the outcome when we get to expiration. A couple different scenarios here. So how about starting with the left column? Once again, where's the stock price at expiration? It's at $50 in this case. Let's go all the way to the right side in terms of the total profit and loss. Now, you've got a profit here of $3,250. So how do we get there? All right, so we bought 500 shares. We now have bottom at $42, and the stock price is at $50. So that's an open market gain, $8. So 500 shares times $8 is $4,000. But remember, at the same time, we purchased that 2-month put, and the out-of-pocket cost is $750. So our total profit is a net of our open market gain less the out-of-pocket cost for the put of $750, or a net of $3,250. Well, how about if this pharmaceutical didn't surge as much and it comes out to 45? Still up, you're still making money on your long stock position, making $3. Well, that's good news. And the reality is that you're still going to have to subtract out that $750. So the net there is $750. But how about the downside? How about the glass half empty scenario? Market has started to move lower. Moves to $40. Now you're starting to lose money. And you're losing money on a per dollar basis for every share of stock. And along with that, you're going to have to add in your put premium. So in a very simple way, at $40, you've lost $2 per share. You had 500 shares, so you lost $1,000. You also have that out-of-pocket expense of $750. So now your total net loss is $1,750. Here's the only good news with a glass half empty scenario. As the stock price continues to go down, your net loss is capped at $1,750. You can see that clearly at the strike price at 35 and at 30. Let's take a look at this on the chart. I like to again call this a different type of a hockey stick. This is what I call the real hockey stick when you're actually at the point of a face-off. You can see the upward sloping line to your right. This basically represents your progressive profit on your long stock position once you go ahead your maximum loss in terms of your out-of-pocket for your put in relation to your strike price. So keep in mind, we looked at where we got in and where we had our glass half empty. So we all like to see stocks go to the upside. Where's our break even? Well, in this case, we own that stock at $42. And we paid $1.50 for each of those puts. So summing those two comes out to our break even of $43.50. We'd like to see the stock go to the moon. We know that our real basis is $43.50. So with that in mind, up to this point, we've shown the one-on-one scenarios. Here's an exact protected put to match the exact number of shares. But what if you decide, look, I don't want full protection. I want to define protection on my own terms, with something a little bit less than the full amount of covering the full amount of shares that I have invested. So this is where the third example comes into play to help put a different look in terms of more optionality, as we like to say, with regard to your risk management opportunities with options. So in this scenario, you might sit as an investor with your largest holding of 2,000 shares of a footwear company that's trading at $75. That's a lot of money. That's $150,000 that you've got risked in the market. The risk is that that's where the open price is trading at right now. But here's the good news. You already have locked in your buy price of $58. So the market's trading above where you got in. This is great. Open market gains. But now you're looking for some protection. And you're looking for it over the next 90 days. But you don't want protection on the full 2,000 shares. You really want to basically go in half. So after reviewing the options chain that you can conveniently find on your online retail broker website by simply putting in the underlying trading symbol and clicking on options chain, in this example, the investor decides to purchase 10 of the 70 puts at $2.10 for 90 days. 10 puts underlies 1,000 shares. Remember, each put contract calls for an underlying of 100 shares. So in this case, the investor owns 2,000 shares of the stock, and they are looking to basically put on a hedge, a halfway hedge with 10 puts. So just to recap, the stock is trading now at $75. And as we said, the investor is cautious on the stock, but really is very happy sitting long from $58. Well, the investor clearly wants to limit downside risk, and if something really bad happens, wants to lock in profits on half of the shares. And there are scenarios where things really bad that can create definite risk with a single name stock can happen. So let's see how we go forward when the investor buys 10 of the 3-month $70 strike puts at $2.10 or an out-of-pocket cost of $2,100. Here's the table. So now we can look at the stock price in terms of expiration, obviously much bigger numbers, But here we're going to look at where the stock on the left side, $80 at expiration. And again, shift all the way to the far right. A net profit of $41,900. So how do we get there? Well, it's very simple. The stock has surged from your holding basis of $58 to $80. So you've got that open market gain. So you're in great shape there. You've got open market profit of $22. So now you've got to look at where do we go from there. Well, you have 2,000 shares. So you've got an open profit here that you now have to net out your out-of-pocket put premium of $2,100. This comes out to $41,900. This is probably the best outcome that you could have imagined. Stock goes up, you're losing $2,100. You don't care, the stock's gone up. What you really care about is what happens when the stock starts to go down. So let's just take a quick look as the stock starts to move. Remember, the market's at 80. Was at $80 at expiration. Now let's look at an expiration price of $70. Well, now the strike that is come into play that you have purchased is what we call at the money. So you're going to still, with an at the money put, there's no means to exercise to sell. You have no reason to do so here. So therefore, your open loss is going to again be the value of that out-of-pocket premium of $2,100. So now that's going to take down your net profit to $21,900. I know as you're looking at this, there's a lot going on here with the numbers. But at any point in time, if you want to go back and reconcile, it's very easy. We've provided the math for you. You can look at the second to last column to the right in terms of long stock profit and loss at the individual stock prices, and go to the column on the left and you can net it against the premium or what you'll pick up in the difference of the strike versus where the market is at expiration. So let's look now as the market has sunk now from 70 down to $60. Well, that long put now is looking a lot better. It's now $10 in the money. And you can look at where you are in terms of your stock. Remember, you bought it at $58, so you still have $2 of profit. And remember, you own 2,000 shares, so you've got a $4,000 net profit at this point. And at this point, now that that put is deep in the money, you can add the value together, coming out to $11,900. As the market continually goes down, you're still in positive territory at $50. You have a net profit of $1,900. So look at $40. You've now realized basically a net loss of $8,100. Okay, let's look at this in a little bit of a different way. We can all reconcile the math that's in this table. But what happens if there's a real washout in the stock? This protected put example is an example where you are basically hedging half your inventory. Remember, you came into this example long 2,000 shares from $58, and you chose protective downside only to cover half the shares, 1,000 shares, which is why you purchased 10 puts, 10 of the 70 puts. So in this example, there's no question you definitely have a lot more protection than just being outright long the stock. I mean, if the stock goes down, you're losing 1-for-1 in terms of that downside movement. And of course, your break even is going to be definitely lower. But keep in mind here, if this stock goes to zero, this position loses $48,100. But if you did not choose this protected put strategy, you lose all the money out of pocket. And that's a definite situation that no one wants to suffer, but that's a reality in terms of single name risk. This type of example gives you a chance to cut the risk in half and determine where you want to basically hedge your pain. So I hope in this example it provides you now a different type of a look. There's no reason to go 1-to-1. You can always go half to 1. You can go in terms of whatever. You might say, look, I'm comfortable hedging just 25% of my position. Some of you may say, look, no. I need to get more. I need to get in terms of the higher 70-80% of the position. Again, it's what makes you happy in terms of your risk management profile. So in terms of managing the positions, just to say that everything that we've gone through today is basically a position that requires decision making. Now, I like to look at the protected put as a set it and forget it trading opportunity. It's a risk management where you know what you paid out of pocket, just like car insurance. You're going to hold it till expiration. But sometimes you don't have that wherewithal to wait. Something has happened in the meantime. Well, you can always determine a different path forward. Keep in mind, single stock options are American style exercise. You have the ability to exercise that put on any day up until expiration. Again, that may be something you choose to do, but in this case, if you're buying insurance, you never really hope that you have to use that insurance, but you always are comfortable that's there. But let's look at in terms of this position, in terms of managing, once you get to expiration. At every point in time with the pillars of options trading, you've determined the strike price, the timed expiration, the premium that makes most sense to you. You essentially plan that trade. And now you're looking to trade that plan. Anytime along the way, as I just mentioned, your motivation or outlook might have changed. So you always have the ability to change your mind. But keep in mind, at all points in time, that money that you pulled out of your pocket to purchase that put is a true investment. And if the stock remains flat or it rises, that option can expire worthless, and that out-of-pocket premium is gone. But there's another part in play, not for the scope of this educational session, that has to do with how all options are priced over time, and that's a measure of implied volatility. You may purchase that put option, and the stock price may go ever so higher or ever so lower, but now there's a lot of uncertainty as to the forward direction of the stock out of nowhere, and that will increase the value of that option likely, and that is a function of implied volatility, or the marketplace perception of what that option will be worth at a future point in time. So in that case, you might say, look, I don't want to hold this put all the way to expiration. It's gone up in value, and the stock has really kind of like gone sideways. I'm going to take advantage of this implied volatility move and sell it out. That's always your option to do as well. So all these positions require basically what I call the roll call or the rollout call. And that is, hey, you're getting close to expiration. Do you want to keep this put and just you see what happens? Is the stock going to have a timing mechanism where it gets into the money or not? You might choose to say, look, my time's almost up, but I'm still really cautious about the stock. I may roll it to a future month. An example of implied volatility going up, you may close it out. Or you may just sit it out and see what happens. In any way, all that takes place is that you and only you can determine your motivation and forecast to determine the answer. And education is a great place to start, which is why the Options Industry Council has a number of educational webinars available at all times to help you further your thought process to determine what may be best for you.
Yeah, I really appreciate it, Dan. It was a great presentation today. We got a lot of responses of appreciation and thank you. It really seems that the attendees enjoyed it. I know I certainly did. So I want to thank you for your time presenting. Welcome to OIC. We're looking forward to many more presentations from you in the future. All of our OIC events are recorded and available for replay. Also, if you're looking for additional education, as Dan had mentioned, make sure you visit that OIC website at optionseducation.org. So that's going to wrap things up. Again, my name is Mark Benzequin. I'm with the Investor Services team. Dan, thank you so much for joining us, and what a wonderful event it was. And ladies and gentlemen, we'll see you next time. Have a great day.